Hi everyone, this is Aki with another tax video. We're going to go over the tax form 1098, which reports your mortgage interest that you've paid during the year. And it may be, just for your information, if you're not itemizing your taxes. If you itemizes your taxes, this is a form that you have to use to file your taxes, because all that information that's on it is very important when you're filing Schedule A, which flows into the 1040. So the basics of it are basically, it has to be issued if you paid more than $600, but many people receive it even if they pay less. It has the lender who's lending you, who's for the loan. Basically, it has the information, their tax ID, your information, and then it has all that financial information that we're going to go over briefly. But first, let me show you where it goes when you're filing your taxes, and in what situation you actually will be using it. So in 2017, the Congress passed the Tax Cuts and Jobs Act, which actually increased the standard deduction, which made a change for people who filing Schedule A, which is itemized deduction. So when you look at the statistic right now, right here from Tax Foundation, before 2018, when the tax law changed, about 31% of taxpayers use the item as deduction. And then right now, after the change of the tax law, the TCJA for short, about 13% of taxpayers still itemize. And you can see based on income groups that the higher income groups are itemizing more than the lower, because it made sense. You have to have a lot of these expensive mortgage, property taxes, real estate taxes, and so on, that a lot of the lower income won't be able to qualify because the standard deduction has increased so much. So for 2022, the standard deduction amounts are: for single, $12,950, married filing jointly, $25,900, head of household, $19,400. So what that means, that if you're married filing jointly, and many couples who are trying to use the mortgage interest deduction, real estate tax deduction, they're the ones who have the homes. I mean, a lot of it, there's still many single people who do have condos, who have houses as well, but there's higher percentage who are filing jointly. They would have to have expenses above $25,900 in order for them to itemize, make sense to itemize, because you get the standard deduction without having to prove anything. So sometimes it's hard. That's why the percentage of people now who itemize, it's much smaller. And where does the itemized deduction goes? It goes on Schedule A. So Schedule A, and I have it right here. Let me zoom it in. It flows into Form 1040. And here on the Schedule A, you have medical, dental expenses, taxes you paid, interest, and this is where you put the mortgage interest. And the interest you pay, this is the area where you deduct your home mortgage interest and points, and mortgage insurance premiums. Now this form is for 2021. We see if it's still going to be the same for 2022. Most likely also will be the same. Now this information from the 1098 goes here under the interest you paid, and that Schedule A information flows into 1040. 1040, you put it right here under standard deduction or itemized deduction. So you have to pick which one makes sense for you. And as I mentioned before in my videos, deduction means it decreases your adjusted gross income or taxable income. It's not a credit that goes dollar for dollar reduction. So it reduces the amount of income you will have, that you will figure out how much tax you owe. Now, if we look at the instruction for Schedule A, and this is like a booklet right here that I have as my PDF, and I highlighted some of these areas that are important to kind of go over. So what kind of mortgage interest can you deduct? A home mortgage interest, any loan that is secured by your main home or second home. So it's important. It can be your main home and or second home as well. It includes first and second mortgage. Home equity loans also are included, and refinance mortgages. And what can be a home? Home can be a house, condominium, mobile home, boat even, or similar property. However, what does it mean? A boat would need to have toilet, cooking facilities, sleeping space, and so on. So it has to have these things to be considered a home. Now, how much can you deduct? You can deduct home mortgage interest to the extent that the loan proceeds from your home mortgage are used to buy, build, or improve your property. So we're talking about not, maintenance, not like small furnishing or something like that. You have to actually remodel your property. You have to build your property. You have to buy your property. So these are the things that qualify the debt. How much of the loan would qualify? And that was changed in 2017, end of 2017 for tax year 2018. So you can only deduct home mortgage interest on up to $750,000 if you're marrying filing jointly. If you're single or filing separately, it's up to $375,000. Now that has decreased from the $1 million that it used to be true for the mortgages before 2017. Now, what about if there's more than one borrower? So I've seen situations when, there's two taxpayers, brother, sister, for what have you, and they have a mortgage and one statement, and many times just one of them might receive it. So what do you do if you're just getting that one statement? You can split as much, if you equal partners in that situation, if you paid equally for the home and you're paying for the mortgage equally, then you can split it. So if there's more than one borrower, you can just make sure you deduct the amount that you actually paid. Then you can also deduct the mortgage insurance premiums. So this is publication 936 about home mortgage interest deduction. And it has more specifics about what qualifies as your home. And here I pulled that and highlighted some areas that are important. So for the second home, if you do have, a home that's not rented out, it can be considered your second home. So if this is a second home that you do rent out, you can still deduct some of the mortgage interest, but there's some qualification. So you must use it for more than 14 days or more than 10% of the number of days during the year for which you rented. So these are the qualifications. Now, home, if it's under the construction, you can deduct that mortgage up to 24 months, but only if you're going to be living in it. So you're not just selling it. You bought it and you have a mortgage and then you're selling it. So this publication has some additional things that you can look for if your situation is unique, and it answers some of these questions. Now let's go over some of the boxes on 1098 and where it would go on the Schedule A. So box 1 is just basically the amount of mortgage interest you have paid, and this would go on Schedule A right here, line 8 right now. That's where you would list it. Now what else do we have here? We have outstanding mortgage principal, so that's as of January of the year you receive it. However, that's just for your information, and the same with the origination date in box 3. Refund amount in box 4, that's basically if you overpaid any interest from prior year, that's very unique. And now in box 5, we have the mortgage insurance premium. So that information also can go on Schedule A. Mortgage insurance premium is listed right there. Now with the mortgage interest and points and insurance premium, like I will show you with the taxes, there's limitation of the amount you can deduct. However, with the mortgage interest and premium and mortgage interest and points, there's no limitation, but the loan cannot be for more than $750,000, as we talked about. Mortgage interest and points will be listed here, but many times in the software, they might be asking in two different areas. So you don't add them up, you would put them separately exactly how it's listed on your 1098. Now, box 7 basically just indicates that the address listed on the 1098 is the same as the address for the property. And if it's not, you have to list the address for the property. Number 10, box, that's really important because often it consists of property tax information that was paid for the property, especially if you had an escrow account. If you had an escrow account with the lender, they may pay the property tax on your behalf, so you might have that information. And that information would go on Schedule A when you have the state and local real estate taxes paid. And you can notice that the taxes you paid information on Schedule A, it used to be unlimited, but now there's actually a limit of $10,000 for married filing jointly. So that's why there's a limit on that. So some people might not be able to deduct the whole amount. That's the most important information to be aware when you receive the 1098. Like again, there's about 13% of taxpayers now that itemize. In the past, it used to be 30%. So you might receive this. You might be just in information. You might not use it. There's an article by NerdWallet that summarizes some of the information we talked about. So I'll link that because it's very user-friendly. It's not like the IRS information that sometimes is overwhelming. So hopefully that helped you understand your tax form and what to do with it when you're filing your taxes. So thanks so much for watching.